Most Americans woke up this week and had no idea that something important just happened inside the U.S. financial system. The first bank failure of 2026 has already taken place. No panic on the streets, no long lines outside branches, no breaking news chaos on television, just a quiet announcement from regulators, a quick handoff to another institution, and life moved on as usual. But here's the real question. If everything was handled so smoothly, why should anyone care? Because in finance, the biggest warnings rarely come with loud alarms. They arrive quietly, hidden inside technical language like unsafe and unsound conditions and impaired capital position. When a bank is forced to shut its doors, even a small one, it sends a signal about the pressure building beneath the surface of the economy. This is not about one local institution in Chicago. It is about rising interest rates, tighter liquidity, fragile smaller banks, and a system that is being stress-tested in real time. Today we break down what really happened, why it happened, and what it could mean for the months ahead. Let's start with the facts. On Friday, financial regulators in Illinois officially shut down Metropolitan Capital Bank and Trust, a small bank based in Chicago's River North District. The moment the closure was announced, the Federal Deposit Insurance Corporation, better known as the FDIC, stepped in to manage the situation. This event became the first official U.S. bank failure of 2026. At first glance, it may not sound dramatic. After all, banks fail from time to time. But every failure tells a story about the health of the financial system, and this one is no exception. The process followed a very familiar pattern, one that Americans have seen many times before, especially since the 2008 financial crisis. The bank did not suddenly collapse into chaos. Customers were not locked out of their accounts. There was no wave of angry depositors demanding their money back. Instead, everything was handled behind the scenes. The FDIC arranged what is called a purchase and assumption agreement. In simple terms, another bank stepped in to take over the failed institution. In this case, Detroit-based First Independence Bank agreed to acquire Metropolitan Capital's deposits and continue its operations. From a customer's perspective, almost nothing changed. Accounts remained open, debit cards continued to work, online banking stayed active, loan payments were still due as normal. Regulators made it very clear that no depositor would lose any money because of this closure. And that smooth transition is exactly how the system is designed to work. But here is where we need to pause and think more deeply. If everything was resolved so quietly, why was the bank shut down at all? According to official statements, regulators determined that Metropolitan Capital Bank and Trust was operating under unsafe and unsound conditions. That phrase might sound like routine bureaucratic language, but in the banking world, it is extremely serious. It means that the bank's financial health had deteriorated to a point where regulators no longer believed it could continue operating without putting customer deposits at risk. At the time of closure, the bank held roughly $261 million in assets and about $212 million in deposits. By national standards, that makes it a small institution, but size does not always equal safety. Even small banks play an important role in local economies. They provide loans to small businesses, mortgages to families, and financial services to communities. When one of them fails, it raises important questions about what is happening behind the scenes. The FDIC estimates that this failure will cost its deposit insurance fund nearly $20 million. That amount will not threaten the overall system, but it is still a real financial hit. And this is how banking problems often begin. Not with one giant collapse, but with small cracks appearing one at a time. Metropolitan Capital was not a brand new bank. It had been operating since 2005, nearly 2 decades. It served customers in dozens of states and even had international clients. On the surface, it appeared to be a stable, functioning institution. So what went wrong? To understand that, we have to look at the broader economic environment. Over the last few years, the United States has gone through one of the most aggressive interest rate cycles in modern history. The Federal Reserve raised rates sharply to fight inflation. While those rate hikes helped slow rising prices, they also created serious challenges for banks. Higher interest rates changed the entire risk equation. On one hand, banks can earn more money on new loans. On the other hand, the value of older investments, especially long-term securities, drops significantly. At the same time, competition for deposits becomes more intense, forcing banks to pay higher interest to keep customers from moving their money elsewhere. Large national banks usually have the resources and diversified income streams to manage these pressures. Smaller regional banks often do not. They operate on thinner margins. They rely more heavily on local deposits. They have fewer ways to raise emergency capital. And when economic conditions tighten, they feel the pain much faster. That appears to be exactly what happened here. Regulators did not wake up one morning and suddenly decide to close this bank. These situations develop slowly, over months or even years. Capital ratios weaken, liquidity becomes tighter, losses begin to accumulate, and eventually, the numbers simply stop adding up. When that moment arrives, the FDIC steps in to protect depositors and prevent a larger problem. Chicago, in particular, has a long and complicated history with bank failures. Since the year 2000, more than 70 banks in Illinois have collapsed, with more than 20 in Chicago alone. So in many ways, this event fits into a familiar local pattern. Still, the timing is important. This is not happening in the middle of a booming economy. It is happening at a time when many economists are worried about slowing growth, rising debt levels, and ongoing financial uncertainty. And that brings us to the bigger picture. Because one small bank failure on its own may not mean much, but as part of a trend, it could mean a great deal. Now that we understand what happened, the more important question is this. What does this bank failure tell us about the current state of the American economy? The honest answer is more than most people realize. Officially, regulators and financial authorities are treating this as an isolated incident, and for now, that assessment is probably correct. The U.S. banking system as a whole remains stable. Major banks are well capitalized. Deposits nationwide are largely secure. But beneath that surface stability, pressure is building, especially for smaller institutions. The American banking system is not one single entity. It is made up of thousands of banks, ranging from global giants to small community lenders. While the largest banks benefit from massive resources and government oversight, smaller banks often operate in much more fragile conditions. And those smaller banks are now facing a perfect storm of challenges. First, interest rates remain high compared to recent years. That means the cost of funding has increased dramatically. Banks must pay more to attract and keep deposits, which squeezes profitability. Second, the value of many long-term assets purchased during the low-rate era has fallen. This creates what are known as unrealized losses on bank balance sheets. Third, economic growth is slowing. When businesses and consumers struggle, loan defaults tend to rise. That puts additional stress on banks that rely heavily on local lending. Put all of that together, and you have an environment where weaker institutions become extremely vulnerable. That is why this first failure of 2026 is symbolically important. Last year, only 2 U.S. banks failed nationwide. That relatively low number suggested that the system had managed to stabilize after the turmoil of previous years. But the new failure shows that the risks have not disappeared. Think of the current situation as a slow-motion stress test. Instead of a sudden financial crisis like 2008, what we are seeing today is something more gradual. Weak banks are being identified and resolved one at a time under controlled conditions. From a regulatory standpoint, that is the ideal scenario. It prevents panic and protects depositors. But from an economic standpoint, it still signals underlying fragility. Every time a bank fails, even a small one, confidence takes a tiny hit. Businesses become more cautious. Depositors pay closer attention. Investors start asking harder questions. And once a pattern begins, it can accelerate quickly. History shows that banking problems rarely stay isolated for long. That does not mean America is heading toward a full-scale banking crisis, but it does mean that the financial system is not as bulletproof as many headlines suggest. There is another important factor to consider: public perception. The reason this failure was handled so quietly is very deliberate. Regulators know that banking is built on confidence. If people believe their money is safe, the system functions smoothly. If fear spreads, even healthy banks can get into trouble. That is why the FDIC moved so quickly to arrange takeovers and reassure the public. But behind closed doors, authorities are watching the situation very carefully. They know that higher interest rates, political uncertainty, and global economic tensions are creating risks that cannot be ignored. For ordinary Americans, the direct impact of this particular bank failure may be minimal. Customers of Metropolitan Capital will likely notice almost nothing at all. But the indirect impact could be more significant. Tighter lending standards, more cautious banks, and reduced credit availability can all slow economic activity. Small businesses may find it harder to get loans. Real estate markets can cool. Job growth can weaken. These are the kinds of ripple effects that follow banking stress. So where does that leave us going forward? The most realistic view is this: the U.S. financial system is stable, but not completely comfortable. More bank failures in 2026 are very possible, especially among smaller regional institutions. As long as those failures remain isolated and controlled, the broader economy can absorb them. However, If the pace begins to pick up, or if larger banks start facing similar problems, the conversation could change very quickly. For now, this first failure should be seen as a warning light on the dashboard, not a full emergency siren. It reminds us that economic cycles still exist, that interest rates still matter, and that financial stability can never be taken for granted. The story of 2026 in American finance is only just beginning, and this quiet event in Chicago may turn out to be one of the first important chapters. Thank you for watching. Stay informed, stay prepared, and keep paying attention to what is happening beneath the headlines.